Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to talk about 7 key tax rates that you need to know and understand. So if you watch my videos on the channel here, you know that I talk a lot about taxes, and you might be saying, hey, 7 tax rates? What's that all about? I thought there was just one tax table. So in this video, I'm going to make some distinctions that I think are very important for you, especially for those of you that may be trying to optimize your retirement resources and trying to figure out maybe what some of those taxes may be in retirement there. But real quick, before we get into today's video, if you want to learn a little bit more about what we do with our comprehensive financial planning, or if you want to learn more about our retirement course called the Retirement Time Machine, we've got some links down in the description below. Go ahead and check those out. So the first tax rate that we want to talk about here is what we call our income tax base. And essentially, the income tax base is going to be the amount of our income that's going to be taxed at our tax brackets. Here we've got the 2022 married filing joint tax brackets up here, ranging from 10% all the way to 37%. I've talked about it in a lot of other videos here. That 24% bracket is kind of our sweet spot that we talk about oftentimes there. That goes up to $340,100 for 2022. That's where we saw a big expansion of that bracket, also a reduction from what was there previously, which was a 28% bracket, now down to 24%. So a lot of times when we're talking about Roth conversions and things, we're trying to fill up that bracket there. We also refer to this as ordinary income, and the things that are going to go into this are going to be things like W-2 income from employment. If you're self-employed, that's going to be added to that. Sometimes rental income. I should say most of the time rental income is going to be included in that. The exception might be that if that's your primary business, there's some different ways that might fall in there. But rental income would be in there. Short-term capital gains would be part of that. So that's going to be very, very important. And I'm going to skip down the list right here to number 5. And that's going to be your long-term capital gains and your qualified dividend. I don't know, I just wrote that again. But anyway, long-term capital gains. And that's going to be taxed at a different rate. And we've got that right here on this worksheet or on this reference guide right here. So if you're married filing a joint tax return, the first $83,350 is actually at a 0% long-term capital gains tax bracket. Most of us are probably going to fall into this 15% bracket, $83,350 up to $517,200. And then if you're over that, you're going to hit the next bracket up there at 20%. So the way this works, essentially, is we're always going to fill up this income tax base first, okay? So if you have $200,000 of ordinary income, that's going to fill up first. And then on top of that, you're going to hit that long-term capital gains tax bracket there, or qualified dividend income, whichever it may be. So if you have $50,000 of dividends and long-term capital gains, you're going to have a total income, obviously, of $250,000. So that's going to be your total, let's say, taxable income. But $200,000, it's going to be at the income tax base rate, and that $50,000 is going to be at your long-term capital gains tax rate. So very important to make that distinction there. So the next thing we want to talk about here is we're going to go over to number 3. Really probably should have put these in a different order here, I guess, as we're kind of flowing through this. But number 3 is what's called the net investment income tax, okay? And what that's going to be, we're going to assume here that we're, let's say, married filing joint, okay? And so for 2022, if your investment income pushes you above $250,000, you're going to have to pay an extra 3.8% NIIT tax. Sometimes people have called this the Medicare surtax or the Obama tax. This was created as part of that Affordable Care Act, and when that came out, this was one of the ways that they paid for that. So if we kind of go back to our example that we just worked out here, let's say that instead of having $50,000 of dividends, let's say we had $60,000 of dividends, and obviously that's pushing us up to $260,000. So what would happen there is $10,000, or the amount, even though we have $60,000 that's in that investment category, only $10,000 of it is exceeding that $250,000 threshold. So you're going to basically pay 3.8% tax on just that $10,000. So be mindful of that. And especially as you get into retirement, more than likely, if you have some of those non-retirement account assets, those may be what you're selling off, especially in some of the early years of retirement, and that may incur capital gains. You want to make sure, hopefully, that we're getting as many of those capital gains as possible into that long-term category, because again, short-term capital gains are going to fall into that ordinary income at our income tax base. Another key rate that we want to look at is going to be adjusted gross income and modified adjusted gross income. So your adjusted gross income is something you will find on your tax return. That's going to be the income that you have before deduction. So of course that's going to be higher than what's going to end up being your taxable income. And then modified adjusted gross income is basically that AGI, but then it adds back a couple of things like non-taxable interest, any non-taxable foreign income, and also any non-taxable Social Security benefits, which we'll talk about here in just a second. And that modified adjusted gross income, especially for those of you that may be getting close to retirement or in retirement, that's going to be what's going to determine here, number 4, IRMA, which is the income related monthly adjustment amount, and that's going to affect your Medicare premiums. Okay, so here we've got the schedule for 2022, and what they're effectively going to do is they're going to look at what your income was in 2020. So they're always going to go 2 years back on that, and we'll say in the filing joint tax return, if your income, modified adjusted gross income that is less than $182,000, you're going to pay $170 a year for your Medicare benefits, for your Medicare Part B benefits, that is. And if you're married and your income is under that, of course, then if your spouse is also eligible for Medicare, you'll each pay that, just to kind of clarify that. And if you're filing a single tax return, that's going to be $91,000. But you can see if your income just goes up a little bit, okay? So normally in a tax table situation, if you made an extra dollar and you went into the 28 or 32% tax bracket, you're only going to pay that higher tax on that $1. But here, you make $182,001. Now your premiums just jumped up from $170 a month to $238 a month. And again, if there's 2 of you, that's going to be for both of your premiums there, and it can kind of quickly escalate there. These are some big levels of income, of course, but $750,000 or above, you're at $578 a month. So there's a big difference, and it's something I refer to sometimes as a stealth tax. So let's move back to our list here, and let's look at the next one on the list, which is going to be Social Security. I just talked about that a second ago. For most of us watching this video, chances are your Social Security benefits are going to be taxable. That's because the limits that they had for the amount of income that you could get or have before those benefits became taxable was actually set back in, I think, 1982, and it was never adjusted for inflation. So if you're filing a joint tax return, if you make over $32,000 a year, that's going to make up to 50% of your benefit taxable, and if you're over $44,000 a year, up to 85% of your benefits are going to be taxable. They use something called combined income. Again, they've got way too many tax rates and brackets and everything as far as I'm concerned, but that's kind of a hybrid. It's not quite the modified adjusted gross income, but it's kind of. So they add in half of your Social Security benefits on the combined income. They add back in your non-taxable interest and everything to kind of figure out what that amount is going to be. If you're single, that number is going to kick in at $25,000 to $34,000. You're going to be in that 50% of your benefits are going to be taxable. Over $34,000, 85%. My opinion on this, I've talked about it in many other videos, kind of a whole separate subject, but at some point they're probably going to just make 100% of our benefits taxable. That's probably where we're going with that. And last but certainly not least is going to be your state tax. And we're not going to get into a whole lot of detail there because obviously 50 states, there's a whole lot of different rules. Of course, there's states that don't have any income taxes. There's some states that have retirement income that may be non-taxable, or like in Michigan, part of your retirement income is non-taxable. Then you get to a certain amount, then it becomes taxable. So every state's going to have a lot of different rules and everything. So you just want to make sure you kind of understand that and how that works, and where maybe some of those key thresholds or brackets are going to be, where they may change a lot, where it maybe pushes you up into a really high tax bracket. Something else you want to think about too, since we were talking about retirement planning a lot, is you want to look and say, okay, well, hey, I'm in Michigan today, but maybe in retirement I'm thinking about moving to Tennessee or Florida or one of the other no tax states. That kind of goes into my tax planning as well, especially if I'm talking about maybe converting money to a Roth, or doing something like that, or where I'm contributing remitting money to the 401k, if I'm doing Roth or traditional there. So estate tax is very, very important to understand, but again, way beyond the scope of what we're going to do in this video here. So anyway, there you go, 7 different tax rates. I know we kind of made a mess of the board there. I thought it was kind of fun, but anyway, some key information that you need to take away as you're kind of working towards that optimization of your retirement resources. So anyway, I hope you enjoyed the video. If you did, please hit that like button. Make sure you subscribe to our channel. Also check out our other social media. Our Retirement Time Machine is where we kind of do a lot of retirement topics there. We also have our Retirement Time Machine course and the Money Evolution Facebook page as well. We're doing some market updates. In fact, I don't know when this video will go on YouTube, but we did a market update here right before I filmed this one. So check that out. Lots of good information there, and we'll see you back in one of our next videos. Thanks.